Most people think you need a massive salary, a degree in finance, or to be a City of London banker to build serious wealth in the stock market. The financial industry wants you to believe that investing is a highly complex science. They use confusing jargon and complicated charts to make you feel like you need to pay them hefty fees to manage your money. Warren Buffett completely disagrees with this entire system. In fact, he famously said that if you have an IQ of 160, you should give away 30 points to someone else because you simply do not need it in investing. What you actually need is the right temperament. If there is only one lesson you ever take away from the greatest investor of all time, it is this fundamental truth. You are not buying a ticker symbol bouncing around on a computer screen. You are buying a piece of a living, breathing business. Here in the United Kingdom, we make investing way too complicated. We download sleek trading apps on our smartphones, stare at the red and green lines flashing all day, and panic when our portfolio drops by 50 quid. We have started to treat the global stock market like a massive casino. We buy shares based on what is trending on social media or what someone mentioned down the pub. But think about it the way Buffett does. Imagine you bought a local independent coffee shop on your local high street. You would not call up an appraiser to get the shop valued every single morning. You would not panic and sell the entire business just because it rained heavily on a Tuesday and you had fewer customers walking through the door. Instead, you would look at the fundamental health of the business. Are people buying the coffee? Are your costs under control? Are you making a solid profit at the end of the year? That is the absolute core of the philosophy of Buffett. When you buy a stock, or when you buy an index fund inside your ISA, you own a physical slice of real companies. These are massive companies that are selling consumer goods, developing software, building infrastructure, making profits, and paying dividends to their shareholders while you sleep. They have thousands of employees working hard every single day to increase the value of the company you own a part of. Because everyday investors completely forget this reality, they let their fragile human emotions take over the driving seat. They buy when everyone is hyped up during a massive bull market, and they sell in a blind panic when the news anchors on television say the UK economy is struggling or global markets are crashing. This emotional roller coaster destroys wealth faster than anything else. To understand this better, we have to look at the teacher of Warren Buffett, a man named Benjamin Graham. Graham created an allegory called Mr. Market. Imagine you have a business partner named Mr. Market. Every single day, Mr. Market knocks on your door and offers to buy your share of the business or sell you his share. The catch is that Mr. Market is emotionally unstable. Some days he is incredibly optimistic and asks for a ridiculously high price. Other days he is depressed and offers to sell you his share for pennies. Buffett teaches us that you should never let Mr. Market dictate the value of your business. Mr. Market is there to serve you, not to guide you. When he is depressed and offering low prices, that is when you buy. When he is manic and offering high prices, you can ignore him or sell. The stock market works exactly the same way. The daily price fluctuations are just the emotional swings of millions of investors. They do not reflect the true underlying value of the businesses you own. The golden rule of Buffett flips human psychology completely upside down. He tells us to be fearful when others are greedy, and to be greedy when others are fearful. This sounds incredibly simple in theory, but it is brutally difficult to execute in practice. Think back to major market crashes. During a crash, every newspaper headline screams that the financial world is ending. People watch their pension pots drop by 20 or 30% and they panic. They sell their investments at the exact bottom of the market, locking in their losses permanently. When the market drops heavily, it is absolutely not a time to panic. It is a massive discount sale. If your favorite supermarket put all your favorite groceries on a 50% off sale, you would not run out of the store in fear. You would fill up your trolley. The stock market is the only market in the world where the customers run out of the store when the prices get slashed. Buffett sees a market crash as the exact time to buy more of those great businesses at a significantly cheaper price. This is why temperament will always beat intellect when it comes to building wealth. You can be the smartest person in the room, capable of building complex financial models and analyzing balance sheets for hours. But if you panic and sell everything the moment a recession is announced, your high IQ is completely useless. Temperament means having the emotional stability to ignore the herd. It means having the conviction to stick to your investment plan even when your friends and family are telling you that you are making a mistake. It means understanding that building wealth is a marathon, not a sprint. Buffett has held some of his investments for over 50 years. He does not care what the stock price does next week or next month. He only cares where the business will be in 10 or 20 years. So, how do you actually apply this incredible lesson today as a regular investor living in the UK? You do exactly what Buffett has constantly advised everyday people to do. Keep the entire process incredibly simple, highly automated, and terribly boring. First, you must sort out your investment vehicle. Taxes are the biggest drag on your long-term wealth. In the UK, we are incredibly lucky to have the stocks and shares ISA. You get a £20,000 tax-free allowance every single tax year. Whatever money your investments generate inside that ISA wrapper, whether it is capital growth or dividend income, HM Revenue and Customs cannot touch a single penny of it. It is entirely yours to keep. If you are investing for retirement, you should also consider a self-invested personal pension. The government literally gives you free money in the form of tax relief to top up your pension pot. Maximizing these tax-efficient accounts is the very first step to investing like a professional. Second, you need to stop trying to pick individual winning stocks. Unless you have the time to read through hundreds of pages of annual reports every week, like Buffett does, trying to pick the next Amazon or the next Apple is a game for losers. Buffett himself has repeatedly stated that a low-cost broad market index fund is the absolute best investment most people can ever make. In fact, Buffett famously placed a $1 million bet against the top hedge fund managers on Wall Street. He bet that a simple, boring S&P 500 index fund would beat a basket of highly managed, expensive hedge funds over a 10-year period. He won that bet easily. The highly paid professionals, with all their complex strategies and high IQs, could not beat a simple index fund. By buying a global tracker fund or a U.S. market index fund, you are instantly buying a tiny piece of the most successful companies in the entire world. You own a slice of technology giants, healthcare companies, banks, and consumer brands. You are completely diversified. If one company goes bankrupt, your portfolio barely notices because you own hundreds or thousands of others. You do not have to read financial reports or worry about which company will launch the best product next year. You are simply betting on human progress and the long-term growth of the global economy. Third, and this is without a doubt the hardest part of the entire process, you must leave your investments alone. You literally need to do nothing. The business partner of Warren Buffett, a brilliant man named Charlie Munger, used to say that the first rule of compounding is to never interrupt it unnecessarily. Compounding is the eighth wonder of the world. It is the process of your money making money, and then that new money making even more money. It is like rolling a snowball down a long, snow-covered hill. At first, the snowball is tiny. It barely gathers any extra snow as it rolls, but as it gets bigger, its surface area expands. Suddenly, with each revolution, it picks up massive amounts of snow. By the time it reaches the bottom of the hill, it is an unstoppable boulder. Your wealth works in the exact same way. The early years of investing can feel incredibly slow and frustrating. You put away a few £100 every month, and the growth seems tiny. But if you stay consistent and let the years roll by, compounding takes over. The returns on your investments eventually start to outpace the actual money you are putting in from your salary. To achieve this, you need to automate your financial life. Set up a direct debit with your chosen brokerage platform every single month. Time it so the money leaves your bank account the exact day after you get paid. This way, you do not even see the money, and you are never tempted to spend it on things you do not need. Once the direct debit is set up, and the money is automatically buying your chosen index fund, you must practice what Munger called lethargy, bordering on sloth. Do not check your portfolio every day. Do not read the daily financial news. If you find yourself obsessing over the daily price movements, do yourself a massive favor and delete the investment app off your mobile phone. You only need to log in once or twice a year to check that your direct debits are still working. The real wealth in the stock market is never made in the buying. It is certainly never made in the selling. The life-changing generational wealth is made purely in the waiting. If you can manage to master your own internal behavior, if you can stop checking the prices every 5 minutes, and if you can just hold on to a diversified basket of great assets for a decade, 2 decades, or even longer, you have already won the game of finance. You will outperform the vast majority of professional traders simply by sitting on your hands and letting the great businesses of the world work for you. Let us talk about the concept of a moat. Warren Buffett loves to talk about economic moats. In the medieval times, a castle would have a wide, deep moat filled with water to protect it from invading armies. The wider the moat, the safer the castle. Buffett applies this exact same logic to businesses. When he looks for a company to buy, he wants a castle with an uncrossable moat. An economic moat is simply a competitive advantage that protects a company from its rivals. It could be a powerful brand name. Think of a famous beverage company. Even if a rival makes a drink that tastes exactly the same, people will still buy the famous brand because of the emotional connection and decades of marketing. That brand loyalty is a massive moat. It could also be the switching costs. Think of the software your company uses for accounting or human resources. Even if a cheaper software comes along, the hassle, time, and cost of retraining the entire staff to use the new system is simply too high. So, the company stays with the original software provider year after year. That is another incredibly strong moat. As an index fund investor, you do not need to identify these moats yourself. By owning the entire market, you automatically own the companies with the widest moats. As the global economy evolves, the companies that lose their moats and fail are naturally pushed out of the index, and the new, strong companies with deep moats automatically replace them. The index fund is a self-cleansing portfolio. Let us address the fear of inflation, which is a massive topic for people living in the UK right now. When the cost of living skyrockets, the price of food, energy, and housing goes up. Many people think that keeping money in a standard bank account is the safest option, but in reality, inflation is a silent thief. It slowly erodes the purchasing power of your hard-earned pounds. If inflation is running at 5% and your bank is paying you 2% interest, you are losing money in real terms every single day. Buffett has always maintained that the absolute best defense against inflation is owning shares in wonderful businesses. Why? Because a strong business with a wide economic moat can simply raise its prices to match inflation. When the cost of raw materials goes up, the business passes that cost on to the consumer. Their profit margins stay protected, and the value of your shares continues to grow over time, protecting your wealth from the silent thief. Another crucial aspect of the Buffett mindset is understanding the difference between price and value. He famously stated that price is what you pay, and value is what you get. In the stock market, price and value are very rarely the exact same thing. During a massive market boom, people are willing to pay astronomical prices for companies that do not even make a profit yet, simply because they hope the price will keep going up. The price is extremely high, but the underlying value is terribly low. This is a bubble, and bubbles always burst eventually. Conversely, during a market panic, investors will dump shares of highly profitable, dominant companies for pennies on the pound just to get their money out. The price plummets, but the fundamental value of the business remains incredibly strong. This is where the intelligent investor steps in. Most retail investors fail because they cannot separate these two concepts. They look at a stock chart that is going up, and they assume the company is a great investment. They look at a chart going down and assume the company is terrible, but the chart only tells you the history of the price. It tells you absolutely nothing about the value. To succeed, you must train your brain to ignore the price fluctuations and focus entirely on the value of the assets you are accumulating. Let us bring this back to your personal finances in the United Kingdom. We have established that you need to use an ISA or a pension. You need to buy broad market index funds, and you need to leave them alone. But how do you handle the psychological pressure when the market inevitably crashes? Because it will crash. That is a guaranteed fact of investing. Historically, the stock market experiences a minor drop of around 10% every year or two. It experiences a major correction of 20% or more every few years, and every decade or so, we see a massive crash of 30, 40, or even 50%. If you are investing for 20 or 30 years, you will live through multiple massive market crashes. It is unavoidable. The defining factor of your financial success will not be the investments you choose, but how you react during those specific moments of extreme panic. When the next crash happens, you need to have a mental framework already in place. First, turn off the television. The news networks make money by selling fear. A headline that says, "The global economy is functioning normally," does not get any viewers. A headline that screams financial Armageddon gets millions of clicks. Do not consume financial media during a crash. Second, review your actual financial goals. If you are 30 years old and you are investing for your retirement at age 65, a market crash today has absolutely zero negative impact on your life. In fact, it is the best thing that could possibly happen to you. It means that the direct debit you have set up for next month is going to buy significantly more shares than it did last month. You are accumulating more assets for the exact same amount of money. You only lose money in a market crash if you choose to sell. If you do not sell, you have not lost a single thing. You still own the exact same number of shares in the exact same companies. The only thing that has changed is the arbitrary price that Mr. Market is quoting you on that specific day. Buffett also talks extensively about the concept of the circle of competence. This means understanding what you know, and more importantly, understanding what you do not know. You do not need to be an expert in everything to be a successful investor. You just need to stay within your boundaries. Many people lose their life savings by investing in complex financial instruments they do not understand. They buy obscure cryptocurrencies, complex derivatives, or highly leveraged funds because someone on the internet told them it was a guaranteed way to get rich quick. They step far outside their circle of competence, and they get wiped out. Buffett has historically avoided technology stocks for a large part of his career, simply because he admitted he did not fully understand how to predict their long-term cash flows. Even though technology stocks boomed, he stuck to what he knew best. He bought insurance companies, railways, and consumer brands. He stayed within his circle of competence and still became one of the wealthiest men in history. For the average UK investor, your circle of competence does not need to be large at all. Understanding that global businesses will continue to grow, innovate, and make profits over the long run is a perfectly adequate circle of competence. Buying a global index fund keeps you safely within that circle. You do not need to learn how to read balance sheets, you do not need to analyze macroeconomics, and you do not need to predict the direction of interest rates set by the Bank of England. Let us look at the concept of patience. We live in a society that demands instant gratification. We can order food to our door in 15 minutes, stream any movie instantly, and get packages delivered the next day. This constant need for immediate results bleeds into our financial lives. People start investing and expect to see massive returns within 6 months. When they do not get rich quick, they get bored, sell their investments, and look for the next shiny object. The stock market does not care about your desire for instant gratification. The stock market is a mechanism for transferring wealth from the impatient to the patient. This is another fundamental truth taught by Warren Buffett. If you look at the wealth of Buffett, a staggering majority of it was accumulated after his 65th birthday. This is not because he suddenly became a better investor in his old age. It is the pure mathematical result of compounding over an incredibly long period of time. He planted the seeds in his 20s and 30s, and he simply waited decades for the harvest. You must adopt this same generational mindset. The money you put into your ISA today is not for your holiday next summer. It is for your financial freedom a decade from now. It is to give you the option to retire early, to start your own business, or to leave a legacy for your children. When you attach a deep, meaningful purpose to your investments, it becomes much easier to ignore the short-term noise and stay patient. Another major trap that UK investors fall into is constantly tinkering with their portfolios. They read an article that says European stocks are going to outperform US stocks this year, so they sell their US funds and buy European funds. 6 months later, they read that emerging markets are the next big thing, so they shift their money again. Every time they make a trade, they incur fees. Worse, they are constantly trying to time the market, which is statistically impossible to do consistently. Buffett compares investing to a bar of soap. The more you handle it, the smaller it gets. Every single time you tinker with your portfolio, you are dragging down your overall returns. Set your asset allocation, stick to your global index funds, and leave the bar of soap completely alone. We must also discuss the role of cash. While Buffett believes strongly in being fully invested in great businesses, he also always holds a significant amount of cash. Cash is the oxygen of your financial life. For the regular investor, this means having a solid emergency fund. Before you even think about putting money into the stock market, you must have an emergency fund sitting in an easy access savings account. This should be enough to cover your basic living expenses for at least 3 to 6 months. Why is this so important for investing? Because life is entirely unpredictable. Your car might break down, your boiler might explode in the middle of winter, or you might unexpectedly lose your job. If you have an emergency fund, these events are just minor inconveniences. You use your cash to solve the problem and carry on with your life. But if you do not have an emergency fund and disaster strikes, you will be forced to sell your investments to get the cash you need. If the market happens to be down at that exact moment, you will be selling at a massive loss. An emergency fund acts as a financial buffer. It protects your investment portfolio from the unpredictable emergencies of everyday life. It gives you the psychological safety to weather any storm without touching your long-term wealth. Let us dive deeper into the psychological warfare that happens during a bear market. When the market is down 20%, it is very easy to read a book by Buffett and agree that you should buy the dip. But the reality of living through a bear market is completely different. Your portfolio value drops every single day. The financial news constantly interviews experts who confidently predict that the market will drop another 50%. Your friends tell you that they have sold everything and moved to cash. The psychological pressure to follow the herd becomes almost unbearable. This is where you must understand human evolution. For thousands of years, human beings survived by staying with the herd. If the rest of your tribe started running away from a rustling bush, you ran too, because the bush probably contained a predator. If you stood still to analyze the situation, you were eaten. We are biologically hardwired to panic when everyone else around us is panicking. Investing in the stock market requires you to actively fight against your own evolutionary biology. You must train yourself to look at the running herd and actively decide to walk in the opposite direction. When every single person in your office is talking about selling their stocks, you must quietly log into your brokerage account and buy more. This requires a level of emotional discipline that very few people possess. It is the defining characteristic that separates the wealthy from the average. Let us also consider the impact of fees on your long-term wealth. The financial industry in the United Kingdom makes billions of pounds every year by charging management fees, platform fees, and transaction costs. These fees seem incredibly small at first glance. A 1% management fee sounds completely harmless, but over a 30-year investing horizon, that tiny 1% fee will eat up hundreds of thousands of pounds of your potential wealth. This is another reason why the approach of Buffett is so incredibly powerful. By choosing a low-cost index fund, you can reduce your ongoing fees to a fraction of a percent. By refusing to buy and sell constantly, you eliminate transaction costs entirely. By holding your assets inside an ISA wrapper, you eliminate capital gains tax and dividend tax. You plug every single leak in your financial bucket, allowing the magic of compounding to work at absolute maximum efficiency. We should also talk about the concept of risk. Most people define risk as the daily volatility of stock prices. If a stock goes up and down rapidly, they call it risky. Buffett defines risk in a completely different way. He defines risk as the permanent loss of capital. A stock dropping by 10% in a week is not a risk if the underlying business is completely healthy and you have no intention of selling for 20 years. It is simply volatility, which is a normal and expected part of investing. The true risk is putting all your money into a single speculative company that goes bankrupt, resulting in a permanent loss of your money. Another massive risk is keeping all your money in a bank account while inflation destroys its purchasing power over a decade. By investing in a globally diversified index fund, you embrace short-term volatility while simultaneously minimizing the long-term risk of permanent capital loss. You accept the bumpy ride in exchange for the mathematical certainty of long-term economic growth. Finally, let us address the idea of enough. One of the greatest dangers in finance is not knowing when you have won the game. Many people build substantial wealth, but they never stop stressing about money. They constantly move the goalposts. They reach their financial target, but then they decide they need a bigger house, a faster car, or a more luxurious holiday. They become trapped in an endless cycle of accumulation. The ultimate goal of investing is not to die with the biggest number in your bank account. The goal of investing is to buy back your own time. Wealth is the ability to wake up every morning and decide exactly what you want to do with your day. It is the freedom to spend more time with your family, pursue a passion project, or simply sit in the garden and read a book. When you apply the golden rules of Warren Buffett to your life in the United Kingdom, you are not just building a financial portfolio. You are building a machine that produces freedom. You keep it simple, you stay patient, and you ignore the noise of the crowd. You focus on accumulating real, productive assets that will care for you and your family for generations to come.